If you're 65 or older and you've renovated your home for safety or accessibility, a walk-in shower, a stair lift, wider doorways for a walker, there's a federal tax credit worth up to $3,000 sitting there for you to claim. But starting with the 2026 tax year, a rule quietly changed that could cost some seniors part of that money if they don't understand it before they file. I'm walking through exactly what that credit is, the rule that changed, and the one decision you now have to make deliberately instead of automatically. I'm James Cardewell. For 11 years now, my work has been Canadian retirement programs, government policy, and the money issues that affect seniors. I'm not here to sell you anything. This is a credit that's already yours if you qualify, built into the tax system you've paid into your whole working life. My only job is making sure the rule change doesn't quietly cost you money you didn't know was at risk. Nobody at the CRA is going to call and explain this before you file. You find out when your accountant mentions it, or you don't find out at all. Here's what we're covering. First, what the Home Accessibility Tax Credit actually is and the dollar figure behind it. Second, the sister credit it's often confused with, and why the two used to be claimable together. And third, the rule change itself, and the specific decision it now forces you to make before you file this year. Number 1. The Home Accessibility Tax Credit. Think about Rosalind Featherstone, 72, living alone in the same bungalow she's owned for 30 years. Last winter, after a fall in the bathroom, she and her son spent close to $6,000 installing grab bars, a curbless walk-in shower, and a ramp at the front entrance so she could stay in her own home instead of moving into assisted living. Most seniors in Rosalind's position pay for renovations like that entirely out of pocket and never think to mention it on their tax return. They assume it's a personal expense, something between them and the contractor, with nothing to do with the CRA. That assumption costs people real money. The Home Accessibility Tax Credit is a non-refundable federal credit that lets you claim 15% of up to $20,000 in qualifying home improvement expenses, improvements specifically tied to making your home safer or more accessible. Run the math on the maximum, and that's a direct reduction of up to $3,000 off what you owe in taxes. Qualifying expenses include things like stair lifts, wheelchair ramps, walk-in bathtubs, widened doorways, and grab bars, work tied specifically to helping someone age safely in their own home rather than general cosmetic renovation. The move. Anyone eligible for the disability tax credit, or anyone 65 or older by the end of the tax year, should be keeping every receipt for accessibility-related homework, because those expenses are what this credit is built around. It's worth being specific about what actually qualifies, because the CRA draws a real line between accessibility improvements and general home upgrades. A new furnace, a kitchen renovation, or repainting the exterior of your house doesn't qualify just because you're over 65 and it happened to your home. The expense has to be directly tied to permitting access to, mobility within, or reducing the risk of harm inside your home. A stair lift qualifies because it solves a mobility problem. A cosmetic kitchen remodel, even done at the same time, generally doesn't, unless a specific element of it, a lowered counter, a widened doorway for a wheelchair, was genuinely about accessibility rather than aesthetics. If you're not sure whether a specific renovation qualifies, that's worth a direct question to whoever prepares your return, rather than assuming either way. Number 2. The credit it's often confused with, and why the two used to overlap. There's a second related credit called the Medical Expense Tax Credit, which lets you claim eligible medical expenses, including certain home modifications recommended for medical reasons, against your income. For years, a specific overlap existed. Some accessibility renovations, the exact kind Rosalind paid for, qualified under both credits at the same time because a grab bar or a walk-in shower can reasonably be described as both an accessibility improvement and a medically necessary one. Under the old rules, a senior in Rosalind's situation could potentially claim the same $6,000 in expenses under the Home Accessibility Tax Credit and under the Medical Expense Tax Credit, effectively getting two separate tax benefits from one renovation bill. That's the piece that changed. I want to pause here because a lot of people hear medical expense credit and assume it only covers things like prescriptions, dental work, or physiotherapy sessions. It covers those, but the CRA's list of eligible medical expenses is broader than most people expect, and it specifically includes certain home renovations when they're undertaken to enable a person with a severe mobility impairment to gain access to their home, or to reduce the risk of harm, which is precisely the same category of work the home accessibility credit is built around. That overlap wasn't an accident or a loophole. It existed because two separate pieces of legislation, written for two separate purposes, both happen to describe the same category of renovation. The government simply never closed that overlap until this year. Number 3. And this is the rule you actually need to know before you file this year. Starting with the 2026 tax year, you can no longer claim the same expense under both the Home Accessibility Tax Credit and the Medical Expense Tax Credit. You now have to choose one credit or the other for any given qualifying expense, not both. This isn't a reduction in what either credit is worth on its own. The Home Accessibility Credit is still worth up to $3,000 at the maximum, and the Medical Expense Credit still works the way it always has for expenses that qualify under it. What changed is the double dipping, the ability to run one bill through both credits simultaneously. Here's why this matters more than it might sound like at first. Depending on your specific income and tax situation, one of these two credits can genuinely be worth more to you than the other for the exact same expense. The Home Accessibility Credit is calculated as a flat 15%, regardless of your income bracket, while the Medical Expense Credit's value depends on your net income and the total medical expenses you're claiming that year. For some seniors, the medical expense route ends up being worth more. For others, the Home Accessibility Credit is the better claim. Under the old rules, that decision didn't matter as much because you could simply claim both. Now, choosing wrong, or not choosing deliberately at all and just defaulting to whichever one your software picks first, can leave real money on the table. The move. Before you file, or before your accountant files for you, calculate which credit actually saves you more on the specific accessibility expenses you paid for this year. Don't assume your tax software or your accountant automatically optimizes this for you. Ask the direct question. Have you compared claiming this under the Home Accessibility Credit versus the Medical Expense Credit, and which one actually saves me more? Here's a rough way to think through it yourself before that conversation. Because the Home Accessibility Credit is a flat 15% regardless of your income, it tends to be the stronger choice for straightforward accessibility work when you don't have a lot of other medical expenses to stack alongside it that year. The Medical Expense Credit, by contrast, only kicks in above a certain percentage of your net income, and its value climbs the more total eligible medical expenses you're claiming. So if you had a heavy medical expense year for other reasons, prescriptions, specialist visits, mobility aids, folding the renovation into that same claim can sometimes push more of your overall medical spending past the threshold where it actually starts saving you money. Neither answer is right for everyone. That's exactly why this is now a calculation, not a default. This is exactly the kind of rule Rosalind's family almost missed. Her son, who helped her file, initially just claimed the full $6,000 under the medical expense credit out of habit, the way they always had for her prescription costs and physiotherapy. It wasn't until they sat down and actually ran the comparison that they realized claiming the accessibility portion of the renovation, the ramp and the grab bars specifically, under the Home Accessibility Credit instead, saved Rosalind more than running everything through the medical route alone. But here's the catch that applies no matter which credit you choose. Neither of these is automatic. The CRA doesn't flag which renovations you paid for and prompt you to claim them. You have to know the rule exists, keep your receipts organized by category, and make the comparison yourself, or make sure whoever prepares your return is actually doing it, rather than defaulting to whatever was simplest last year. And keep in mind, this isn't a one-time decision you make once and forget. If you're planning further accessibility renovations in the years ahead, and a lot of seniors do this in stages, a bathroom one year, an entrance ramp the next, you'll want to run this same comparison every single tax year going forward. because your income, your other medical expenses, and even the specific renovation itself can shift which credit comes out ahead from one year to the next. What worked best for Rosalind's ramp this year might not be the better choice for a stair lift she installs 2 years from now. So circle back to where we started. Rosalind's $6,000 renovation, done specifically so she could keep living safely in her own home, is worth up to $3,000 back through the home accessibility credit alone. And now that the stacking rule has changed, getting that number right means actually comparing her options, instead of assuming both credits apply the way they used to. If this helped clarify a rule that's easy to miss, hit subscribe and send this to anyone you know who renovated their home this year for accessibility or safety reasons, before they file, not after, because this is the kind of comparison that's much easier to get right the first time than to correct with an amended return later. I'm James Cardewell, and I'll leave you with this. Claim what's already yours. Talk soon.